Zach, I cut myself shaving this morning. This beautiful, handsome face.
Did you really?
Right there, that little, it got infected and it smarts.
I can't tell
It
at
smarts a little bit like my portfolio.
all.
But you know what? It's recoverable. Unlike some of those pie charts, so bonds last year had the worst year ever.
Yeah.
That they've been keeping records for 97 or 98 years, and stocks really took it on the chin too. And so it really hurt last year, 2023, for most people, especially if they bought and hold and didn't get defensive. But what's in store for 2023? That's really the million-dollar question. Now, nobody really knows for sure. So how are you going to handle 2023 when you're getting all these forecasts and prognostications about the end is near or we're going to have a huge rally, and they're just all over the board. So you really don't know what to do. We're going to dive into that and to tell you how we're going to handle it and what we're going to do and how we want to participate. And then what's the status of crypto?
What is the status of crypto?
Is it dead or is it going to recover?
Ooh, yeah.
And I mean, did SBF kill it? Now, and there's articles I put them. I don't want to dive too deep because there's a whole bunch of articles on the show list that I sent you from cryptos being a scam.
Yeah, lots in the description this week.
To the global crypto standards, which are the standards for kind of the exchanges, the regulation, the rules. And it's quite detailed, so I'm not going to dive into that. But if you want that, that's like a 10-page article, very detailed if you know. But speaking of dead, if you do own crypto, do you need a special crypto estate plan? Actually, the answer is yes.
Oh, really?
So not only did you get kicked in the teeth and then kicked in their backside and then run over, if you had crypto, but now you also got to go pay an attorney to get a decent estate plan so that it transfers correctly. And really, here's the main thing, folks. The main thing you need to know is you need to have and there's another article on that, you can read it, but you need to let your heirs know where that crypto Dropbox, where that key is.
Yeah.
Without the key, you can't get in.
Yes.
Right? And they're also saying that you should keep it, like on a flash drive. You don't really want to keep it online and stuff like that. And then our 529s, the new Backdoor Roth. The new Secure Act 2.0 made some different rules. And we'll talk about that real quick. And what are most advisors concerned with in 2023? Well, let's just hit that real quick.
Yeah.
Right now, where is that?
That's
Number
a great
one, because this
start.
is quick. Number one, inflation, 33%. Asset preservation, 15.2%. Interest rates, 14.3%. The interest rates and inflation kind of go together, I think, but that's about 45%. Market growth, 11% rounding. Geopolitical risk, 10% rounding. Income generation, 7%. And diversification, managing correlation risk, only 6.4%.
Only 6.4.
So only 6. What that means, folks, is that's why your portfolio, if you had a pie chart buy and hold, you got slaughtered and were down anywhere from 20 to 30% last year, depending. And if you were lean more toward the growthy pie chart portfolio and you bought and hold, you were down more than that. I mean, the leading stocks from the last cycle, a lot of them were down way over 50%. So, but here's what I don't understand. These guys don't realize that the diversification story, when it goes down, all the correlations grow together and it all goes down together. So why wouldn't you have more worry about the diversification and managing correlation risk when you got slaughtered with both stocks and bonds last year? 60-40, the balanced portfolio didn't work at all. So I would think that would be a little bit higher, but what do I know? All right, now let's talk about, and then we're going to get to the mailbag, but let's talk about very quickly this 529. Folks, it is a very tough market right now. It keeps doing these head fakes. And so people are getting very frustrated. That's understandable. That actually marks a bottoming process. I'm not saying we're at the bottom yet. We could have another leg down. Okay?
Sure.
but near or off the bottom is when investors become the most frustrated. So actually, that's kind of a bullish sign as far as looking out on the horizon. I know that's counterintuitive, but Warren Buffett, my favorite lobbyist hack. Well, he's a good guy. Whatever. I'm not going to go to that, but I just think he's disingenuous. He plays that good old boy, Nebraska farm boy really well, but he's actually very shrewd and ruthless businessman.
The good ones are.
With inside information with Congress, with the politicians. But, he was the one that has said that you want to sell when people are bragging at cocktail parties how much money they made, and you want to buy when there's blood in the streets. You've heard that story, right?
I think I've heard that.
So anyway, now, 529 plans are the new backdoor Roth. So this new Secure Act 2021 said now the new capability for owners of 529 plans to roll out the unused money into a Roth IRA. So now you can do a Roth conversion, or a Roth. It's not really, I don't even think it's a conversion, is it? I think it's just you can roll it directly in there, so it's not even taxable. But you can put the money into the Roth. I'll have to double check that conversion part, whether it's taxable at that point. But you can put the unused Roth. So if you've got a 529 plan and your kid's got, you've done it over the years, grandma and grandpa put in money, and you got in, 120,000 or whatever, it only uses 80. Now you got 40. Oh, but there's a catch. The limit is 35,000 per beneficiary. Now, how do we know Congress is incredibly stupid? I'm going to tell you.
We're waiting.
Because at first blush,
it could take a while.
Yeah.
The first blush, yeah, a War and Peace novel.
Yeah.
The owner of a 529 plan that held more than 35 in unneeded assets could theoretically change the beneficiary multiple times and do a series of 529 rollovers for the $35,000 maximum. Folks, let me explain that in plain English. So on your 529 plan, people were opening up multiple ones because and they were saying, well, if you don't use it for Jimmy, you can transfer it to Betty when Jimmy's gone and done from college. You can put it to your second child or your third child, and they can use it for college.
Yeah.
So what they're saying, because there's not a lot of clarity yet, they haven't caught up with the rules. You could actually have $70,000 in there, have one beneficiary named, roll out $35,000, then name it to one of your other kids, and then roll that out. 35,000. So we'll see if they correct that. But folks, what that also means is planning going forward. If you are going to do a 529 plan, which I'm not recommending, I'm just saying they've got some structural problems in my opinion, but open up a couple different 529 plans with different beneficiaries, one child and the other child. Don't super fund one. That way it'll make you more flexible in case they do change the rules. So you can't simply change the beneficiary on one single 529 account. Okay? All right. Now, next one. Could bonds be the next? Did I bring that up? Did I say are bonds the answer? Oh, well, I stopped. That was one of my other headlines because I stopped when I talked about what are advisors most concerned about. All right. This is a guy talking about why bonds could be the answer. And by the way, we're going to talk about that in a little bit, because the charts seem to be looking up. Don will tell you about that. And folks, by the way, we're not a one-trick pony. We don't do just all growth stocks. A lot of people believe that. We've had gold, we've had big blue chip energy stocks, we've had other things, and we've had bonds before. But while interest rates were rising and inflation was raging, we didn't own any bonds. Why? Because they had their worst year ever in 100 years.
It's a clunky year for bonds.
Okay, but now that you've had that big washout, is it time, and especially if the Fed stops raising rates? So the fundamental structural things and the interest rate cycle are all aligning to actually be setting up for bonds. Now, what this guy is saying is he's talking about fallen angels, and that's a little tricky. Fallen angel is an investment grade bond that falls from grace. The analysts say, you know what, your stuff is going down a little bit, and so they get downgraded to the highest level of junk or high yield, but they have a higher yield. And he's basically saying you either want to do fallen angels or high yield bonds, junk bonds, right? And then from there, because they'll have a higher yield, you'll get a good. Now, this guy's also kind of assuming that we're probably going to get a fairly soft landing. See, high yield bonds are great. They act a little bit like bonds, but they can also act like stocks. So when we get really bullish in the market, things go up, and some of these are even convertible into equity. They act a little bit more like stocks. When the market is when the economy is getting really, really tough in recession, they start trading like stocks because people are worried they won't be able to pay back the principal. So high yield, and the way you know that is the spread between high yield and investment grade or treasury bonds. When that spread is narrow, there's not a lot of premium for the high yield. That means risk. People don't see the risk of a lot of defaults. So they're willing to invest and take a chance in those higher yielding bonds. And when more people buy in, it pushes the yield down and the price up. Okay. When people are getting scared, that yield will widen considerably. And that's how you know that people are getting more risk averse. Okay. You follow me on that, Zach? I know these guys got it.
I'm keeping up.
Okay. Well, if you're keeping up, then I think
Yeah.
our non-stock nerd listener can follow it. So in any event, are bonds going to be the place to be? That's going to be, and so if bonds look up, we will actually take a position in bonds. So Zach, do you know what the difference between a high yield bond and a junk bond is?
No.
Nothing. A junk bond is
right.
when you go to a broker in the brokerage business, it's not about the investment business, it's about the changing of the investment business. They got to sell everything you transferred in and buy all their funds so they get paid on those. Okay? So when you come in and you've got a portfolio and he needs you to sell that stuff so he can put you in his stuff, he calls them junk bonds because that sounds risky, right? Sure. But if he's trying to sell it to you, boy, those are high yield bonds. Those are beautiful, man. Let's put some lipstick on that pig, some earrings, maybe a choker, you know? So in any event, folks, it doesn't matter whether it's high yield. It doesn't matter if it's junk bonds. It doesn't even matter if it's investment grade or treasuries. The question is, are interest rates peaking and likely to stop rising? Is inflation starting to subside? And if we are going into recession, especially a softer one, that's the time that you'd want to go into bonds. The stocks will struggle a little bit or could struggle. They may not necessarily, they may rally, but that's how you know. So Don, you want to jump in? I know you got a treasury bond chart sitting there, so I know you're dying to chime in. Go ahead. What are your thoughts?
Dying to make a comment, Dan. That's right. You know how we don't diversify into downtrending charts just for the sake of diversification at Revere. I liken it to trying to eat a balanced diet, but you go to the grocery store and all the vegetables are rotten, but you buy them anyway because you got to have vegetables to have a balanced diet. No, don't do that. And don't buy bonds when they're in a downtrend. But the trend starting in November for bonds has started to change from a downtrend to at least an intermediate term uptrend. And a lot of that is based on uh, the inflation fear somewhat being dissipated with the data that started coming out from the Fed. So you can see the long downtrend of TLT. It peaked in December of 2021. Here's a comparison chart for the full year of 2022 TLT. This is the long-term bond down 32.82%. So I'm going to put a couple of other bond indexes on here, but first I'm going to put the S&P 500 on here because, again, what we try to do, or what the standard answer from Wall Street is you got to properly diversify. But again, diversifying into downtrending charts doesn't do anything. So there's the S&P 500 down 19.4%. Bonds are supposed to shield your downtrend, right? Well, TLT down 33%. BND, this is a most likely, if you were in a pie chart, you would be in this ETF. This is a broad bond ETF down 15%. If you went out into the world and included some world bonds, and this is the ETF that we use for the 60/40 statistic that we put every night in the video, that was down 14.5%. Well, how about corporate bonds? LQD is a corporate bond index, down 20.4%. How about junk bonds, like you mentioned? They act like stocks. They were down 17.1%. So really, there was nowhere to hide in bonds. But let's get back to a more recent picture of those indexes. Here's the TLT. As I said, it put in a bottom in late October, started trending higher in November. Let's bring up a broad bond index here. Actually, of this week, the 200-day moving average for the first time since December of 2021. Junk bonds, is there a fear in the credit market? No, junk bonds are acting just fine above the 200-day moving average. How about corporate bonds? Are we scared there because they're all corporations and we see a recession coming? No. Investment grade bonds are above the 200-day moving average also. And then I showed TLT, which has certainly been improving. So we are weighing our options for diversify. We actually already started doing this for accounts that we manage that are just 401ks that only have ETF options or mutual fund options. We've already started adding some bond allocation to that, but we're looking to add more for some of the Grotection clients also, possible small allocation to bonds. What we did do for Grotection clients is go into short-term T-bills over the last few months, which we're able to, instead of just a money market paying pennies on the dollar, not even a penny on the dollar, fractions of a penny on the dollar, let's say that, we've been able to get a yield of between 3.5% and 4% on T-bills. Now, T-bills, meaning you buy them below par or below the face value, and on their maturation date, they reach face value. So if face value is 100, when you buy it, you might be at 99.65, and little by little it ticks up, and when it matures, you're at $100. So there's no risk in the chart that way. In fact, if you own those while bonds were in a downtrend, losing your money if you were invested in individual bonds that had a maturity date, a fixed maturity date. Because really, if you're diversified into bonds here using one of those bond indexes, what you're doing is losing because the net asset value of the bond ETF is going down as interest rates go up. Dan mentioned the inverse correlation there, but again, that stopped in November. We started getting, first we got back above the 21-day. This is how uptrends work across various time frames. Then we get above the 50-day. Now we're working on getting above the 200-day, meaning the long-term trend is back positive for bond ETFs, very similar to bond mutual funds. That would work the same way, that would have the same investment crisis or investment theory, whether it's broadly diversified or corporate or whatever. But bonds absolutely looking better is the bottom line.
Yep. No, they actually are shaping up. All right. So we're going to hit the mailbag very quick. There is one other article. It's kind of, it's boring to me because I've been following this for so long, for years, but the financial services industry is lobbying the Department of Labor because they're coming out with these new rules, and they're worried about these duly registered advisors. They're really brokers. They work on commission too. And these new rules are trying to force these brokers to be advisors with no conflicts of interest. You can't be a broker and not have a conflict of interest. It's impossible. And so they're kind of forcing these old brokers to either retire or change their business model. First of all, I think it's a flawed business model. I don't like it. That's why I became a fee-based only fiduciary, like clear back in the late 90s when, early on. But that was the broker model was the accepted model for decades. And in my opinion, it's not really fair to all of a sudden just screw these guys, kick these guys out or these girls. I think they ought to phase that in. But that's just an interesting article to read. All right, now to the mailbag. And this is going to be long because we actually got quite a few very, very good questions. And folks, if you've got any questions or comments, or you want a topic discussed or a stock you're looking at or just anything, you can email me, Dan@revereasset.com, and I will make sure I get it in the mailbag. All right. So, hi, Dan and Don. Like many others, I've been following your analysis since Don's interview with Richard Moglen. If you haven't seen that, go get it or email me and I'll send it to you. It's a great art, great video, and greatly benefiting from it. On this week's podcast, last week, Dan mentioned he's allocating to bonds and 401k accounts where he's limited to mutual funds. Can you comment on the way you're expressing your bonds thesis here? I'm in a similar situation and have added exposure to short duration bond mutual funds in the last month, but I'm also earning 3.9% on my cash, so I've been hesitant to move away from this risk-free return on my equity positions. Thanks, guys. S. First, thanks for watching our content and glad you enjoy. Regarding the 401ks, they all have equity indexes and either bond indexes or bond funds or bond sectors, high yield, investment grade, corporate, treasury, etc. So each 401k is slightly different and nuanced. But with 401ks, we either increase the exposure using the mutual funds provided, and this is if they do not have a self-directed brokerage option, which some employees do, but the employees are completely unaware. As far as yields go, for fully managed accounts, we have been using Uber short-term T-bills, that's what Don just mentioned, paying around 4%, annualized, so you got to keep rolling them, but they're only a month out. They mature within a month. But with 401ks, it all depends on their specific choices if they don't have self-directed brokerage. If they do have self-directed brokerage, you could use the T-bills that we're doing. If they do not, you need to use whatever choices they are available and reverse engineer with the bond fund options available. So without looking at your choices, I cannot give you good advice specific to you. Thanks, Dan. S. That 3.9 you're getting is cash. I think this was Don. That 3.9 yield you're getting is cash is pretty attractive. I'd say you're fine. I'd say you're fine if you stick with that and not risk possible downside of a bond mutual fund. We'll explain that in a minute. Don, don't let me forget. Then I chimed in. Agreed. For outside 401ks, if not longer term or without any surrender. So I agree on the 401ks if they're not longer term or without any surrender penalties. And then Don said, I was assuming that was inside your 401k. He answered back, Don is correct. 3.9 is inside my 401k, either in a fixed fund, a guaranteed investment contract, or stable value. I'd use the bond. Then I'd use that instead of the bond mutual fund. So Don is correct. All right. He said, thanks, guys. Yes, through Fidelity, I have a self-directed brokerage option, but I can only choose a variety of mutual funds. And he does have this special Fidelity cash reserves if you have enough money in there. He said, I was able to navigate through last year with only a 13% max drawdown, thanks in part to your content. I'm still 40% cash, but scaling back into equities in this 401k. And my interest was piqued when you mentioned the bond allocation this week. Thanks. So this is me kind of explaining it, and also for your listeners' benefit. If you have brokerage link, not always. I need to clarify this. I thought he did. You can do individual stocks. We manage quite a few brokerage link 401ks with the Grotexan strategy. But if you can also do individual T-bills, you can roll them weekly and ladder like we're doing. Dan, unfortunately, my employer limits our options to mutual funds, so I can't really manage risk the way I otherwise would, and I have to deal with the dreaded 30-day excessive trading policy. Thanks, S. Me. Yep, we deal with that. These two, unfortunately. We need to keep a spreadsheet and work around the rules they give you within your respective 401k and possibly use longer term, meaning midterm, technical indicators. So, folks, on these 401ks, you can have the full-blown self-directed brokerage option where you can do individual stocks or ETFs or whatever you want. Then they can say, or we'll give you full brokerage, but instead of the 12 pre-selected mutual funds that we've selected that we like, and we may or may not get a sharing ratio with to help offset the cost of the 401k plan, we'll open it up to all the funds on the Fidelity platform or certain funds. So if you have self-directed brokerage, you could either have individual stocks. In fact, at Revere here, because all my guys, we're professionals and we know how to manage money, they can even do options in their 401k if they want, right? I'm not trying to protect the client, and these guys know what they're doing. So I've allowed them that freedom, right? So 401ks can actually own anything from physical gold to real estate to individual stocks. The sky's the limit. But because the employer's on the hook and a little scared, they're going to try to whittle it down to like 12, 15 funds. But lately, they've started to open it up. So the first thing you need to do if you have a 401k, number one, rule out that you do not have a self-directed brokerage option. If you do, there's a cheaper way to invest and go with a plethora of more options. Okay? You may even be able to short in there using a short-selling ETF in an ugly market, or at least hedge the stocks you have. Okay? If you do, and then if you have self-directed brokerage, find out what the options are. Is it stocks or is it just mutual funds? Okay? If you don't have self-directed brokerage, then you want to look at the mutual fund choices you have and or any restrictions you have on it. And from there, you figure out the strategy. Because 401ks can be clumsy. Folks, that is very complicated. In fact, the ERISA part of the tax code is the thickest part of the tax code by far. It's 4 feet thick. And that's why the ERISA attorneys make about $600-700 an hour. So if you've got any questions on that, just email me, dan@revereasset.com, and I can go over your choices. Okay, new one. Good morning, Dan and Don. This is Monday the 16th. I'm curious if you ever use the weekly MAs for entries and exits. I know Tim was a big proponent of buying on the weekly 5-8 cross, the 5 exponential, 8 exponential cross. Hammered this home over and over. Looking at TMDX when we had that quick pullback this month, the weekly chart reveals that we pulled back right down to the 20 simple moving average on the weekly and then had a nice bounce. The same happened in early October. I also noticed that the MACD crossed back in early March and the stock has been on fire ever since. Similar conditions apply to ELF also, as it has had a nice pullback to the 20 weekly 20 or close simple moving average on January 12th and then bounced. I got stopped out on both of these. I am trying to look at longer time frames because I tend to lose the forest through the trees more often than not, and I am working outside the house, meaning I can't pay attention to it intraday. I need to trade longer time frames. Right now I'm watching IMND. I've brought this up to Don before. I would be interested to have your guys revisit this, or maybe one of the new guys can do some research. I owned the stock at $33 a share back in 2020 when it came up in this New America section of the IBD newspaper. It ran all the way to 99. I missed the move, and it has now come back down to 32. Ouch. I do know that if the stock, I don't know if the stock is broken. I think they have good fundamentals. Trading above the 200-day simple moving average, $31 a share, and they report earnings on 2/14. Thank you, CK. Hi, CK. This is Don. INMD was discussed internally by the team over the past 2 weeks as a promising setup. It failed miserably this past Wednesday, the 11th, on huge volume, then followed through to the downside on Thursday and Friday, despite raising guidance. Fundamentals are a lagging indicator and will always look best at the top. As O'Neill said, buy on the fundamentals and technicals, but only sell on the technicals. I can emphatically tell you that the 5-8 weekly cross is no holy grail. In a bear market, weekly charts will get you crushed, as the tendency is to close the week near the bottom of the range, just as the tendency in a bull market is to close the week near the top of the range. That's one of the that helps define a bull or bear market. In a bull market, weekly charts absolutely can help you keep in the stock, meaning not get you shaken out with daily with the noise, and they avoid intraday noise. All systems must be used in the proper context of the overall market, bullish, sideways, or bearish. Bullish setups in a bear market are more failure prone. I added the more in there, are failure prone. In bear markets, the only successful approach is to sell strength and buy weakness at support. Thanks for reaching out, Don. Then CK on Tuesday the 17th. INMD up 6% today. Could be a run up into earnings. We shall see. I've got a small position on, and Don said, excellent, congrats. So, any comments on that, Don? And then how well did that INMD age? 2 comments.
Sure. Zach, can you show the charts?
Absolutely.
Okay, this the 6th was when it broke above this tight consolidation, and we started putting it at least on our internal watch list. But what happened in the subsequent days was it gave back that move. It bounced where it was supposed to, and then that day that it supposedly upped guidance, it was down 9.6% on 416% volume. This is a classic O'Neill high volume break of the 50-day moving average, and it's a sell rule. We go to the 60-minute chart. You can see this is the day that we started discussing it. It broke above or at least into the top of this recent range. Correct, we're in a bear market and selling strength is more the way to go. But I've detailed in videos since the first that breakouts have been working better. They pulled back recently in a couple days. They're back reclaiming some gains today, but it's still a tenuous market since we broke back below the 200-day moving average earlier this week. So this was the day that InMode gave the guidance and gave it all back. And then, or no, it actually wasn't. It gave it back, but this was the day when they gave that guidance out and it broke it all back. Then you can see the bounce up here to 36, but what does that coincide with? That coincides with the previous levels that were acting as support and have now turned to resistance. The 50-day moving average, the 21-day moving average, it bounced up into there. That's a classic bounce up after a high volume sell-off, and it should have been sold there because it's back into resistance. So this is a broken stock to me right now. It's still above the 200-day moving average, but we don't own things that are below the 21 and the 50-day moving average when we're trying to identify leaders. This just plain and simple isn't a leader if it's acting that way. If you look at it from a technical standpoint, the 3-month relative strength is a 12. That means 88% of all of the stocks in the entire market are acting better than this. On a 6-month basis, it's a 35, which means 65% of all the stocks in the market are outperforming it. And on a 12-month basis, the relative strength is a 61, which is still fine, but lately it's been a laggard, and we want leaders, not laggards. There are a lot of medical type stocks that are acting very well, and this isn't one of them. It tried to break out here. The breakout failed. When the breakout fails, you can't hold on to hope, such as saying maybe it'll run into earnings. Well, maybe it won't. We look for leaders, and this isn't one, plain and simple.
At the moment, and that could change later.
At the moment, sure, it could always
yeah,
change,
yeah.
but we go based on the evidence that is presented to us at the time.
Sure. So, folks, just because you've got the N in CanSlim, you've got the new, you've got the story, the chart, the technicals have to confirm the story. And so, and there can be time frames that it does and time frames that it doesn't. So, and that's what Don's saying. Right now, this stock is broken. And speaking of medical, the final mailbag, Dear Team Revere. I like this guy. This guy's a listener because we went from Revere to Team Revere instead of the Revere team. I like this. All right, Dr. Mark, thank you. Dear Team Revere, mailbag. He's actually clarifying for me to make sure I get it the mailbag. If you need a week to research, that is fine. If you believe that we are in the second inning of a drug therapy for obesity and it's going to be a mega market for big pharma, how would you invest? It's just the big three. Is it just the big three, or are there smaller companies that would profit? Hope to hear from Ted or Michael on the podcast. Thank you, Dr. Mark.
Wow.
One thing I'd like to say real quick before I throw it over, Dr. Mark, you are right. We are fat as hell. and we are like the most obese country in the world. But I'm doing my part, man. I've dropped 25 pounds.
Wow.
I'm looking good.
And bragging about it.
And it's without the big pharma therapy.
Yeah.
It's without the big pharma therapy. So take that, Pfizer.
That's right.
All right.
What are you doing? What have you been doing, Dan? Have you been working out, or you been starving yourself, or what have you been doing?
Well, kind of actually, I just have made it a point to eat healthier, but I also, I was a professional athlete, and so years ago, I mean, I'd eat like at midnight, right before I went to bed, and I couldn't gain a pound. I could not keep,
right.
And I'd lose 8 pounds during a match, and I'd gain water weight, and I'd gain it right back. And anyway, I just never gained weight. Well, when I started doing this business slowly over time, I'd start gaining because so what I do is I only eat 3 meals a day, if that. Sometimes I'll skip a meal, but I also don't gorge myself. I eat slower, and I only eat about half to 2/3 as much as I used to. And you know what? I'm still just full. I would eat too fast, and then I'd be full and feel tired. And so I'd really just kind of change my eating habits, not as much as my diet. So it was the volume of consumption. And my next goal, Don, is to go start working out more. Thank you for pointing out my frailties. All right, well let's throw it over to Don. I'll let you lead. Which analyst do you want to go to look at this?
Let's go over to Teddy Bear first and see what he's got for us.
So
this is the 555. This is the 555.
The 5 at 5 at 5 segment. Yeah,
I know it was a bunch
5.
of us.
It's not 5, but each of our 3 awesome analysts have 5 stocks to present.
3 at 5.
So take it away, Ted.
So before I talk about my segment with regards to Dr. Siegel's question, I believe Michael and I are going to take a look at the sector. And from a high-level overview, it seems that it is a duopoly between NVO and Eli Lilly. But we'll take a look and see if there are smaller companies that are also in the obesity space.
Okay, so we'll come back to that later. Is that next week?
We'll come back.
Okay.
Yeah, next week.
Okay.
No, we'll
folks, he just sent this email to me yesterday evening, so we didn't really have a time to do a deep dive. And he did say in his email, just you can wait till next week.
It's coming.
Yeah. And then for my segment, I just wanted to comment that as the markets are pulling back after this recent thrust up, it's become clear what the relative strength stocks are and themes are. And as Don mentioned before, he assigned me, Connor, and Michael sectors to track at a deeper level. And so the sector that I want, or the industry group that I want to talk about today that is showing significant relative strength, are some of the semiconductor stocks. There's a basket of them that are acting very well. And so once we identify which stocks are the ones bending against the market, resisting the decline, that is what we want to get on as the market turns up at low risk entry points. And so in the recent market, in the recent pullback, 4 of these stocks have broken out and now are pulling back a little bit. And the first one is ACLS. And as I go through these, they're above all their key moving averages and still acting fine. And so just keep it on your watch list. The second one is RMBS. Once again, broke out. I definitely would like to see digestion before breaking out. So this pullback might give it a chance to just calm down for a little bit and go sideways. The third one is AEHR. Same story here, premature breakout, just ran up the right side. Digestion is definitely healthier, which is what we're getting now. And same thing.
We own this one in growth sections.
Yeah. And then PI is the fourth one. Same thing, broke out and back into its base. Just want to see this one digest its recent gains. And so the fifth one poked its head out and got hammered back down into its handle. It's a little ominous, but it's fine because, again, like I said before, we want to see more digestion on the right side of its bases to tighten up and prevent present a lower risk entry point. And ALGM is this one I'm talking about.
ALGM as in Mary?
M as in Mary. Yeah. So as you guys can see in all these semiconductor stocks, we're seeing significant relative strength. We're seeing base building, which is healthy. Four of those broke out, ran up the right side. It may be a little premature, but this recent market pullback gives them a chance to and build out that right side. You can notice that the relative strength line has been trending up for the last 4 to 5 months or even more, and that is a good sign for stocks that we want to hop on board if we did bottom and if we are turning out. And that's my section.
All right, 5 semiconductors. One of the they're a little on the thin side, which would mean we would be limited in the position size that we had to take if we got them into portfolios. But we do, as I said, own AEHR right now. It's a volatile one, but again, that's why we keep position size small to account for that. Connor, you've got 5, and they're probably not all good charts based on our pregame. So take it away.
Yeah, so it's a little different than what I'm normally doing. I wanted to highlight 5 stocks in my sector that some bad news that has recently came out, showing some warning signs and not looking the best. So the first one I wanted to highlight is CELH. Now, this is one that I really liked in the past. I love the story. I like their growth and whatnot, but recently it's not acting like a leader. It just broke below the 821 and the 50, although it still is above the 20. And there's been big news this week. Actually, flo-rida just recently won an $82 million lawsuit. And what the lawsuit was for was Celsius basically breached the contract that they had. So they agreed to pay flo-rida royalties on cases being sold and to increase his stock compensation and options as the company grew. And flo-rida helped the company a lot. He brought a lot of eyes to the drink, to the business, and Celsius did not hold their word with him. And he just recently won the lawsuit, and I think the funniest part of it was there was a video circulating online. Moments after the verdict, he was thanking the jury and the judge while drinking a Celsius. So quite ironic.
He got something like 86 million, wasn't it, worth the value, the 1% of the stock that he got?
Yeah, I had like 82 million. Yeah. It was some crazy number.
It's in the 80s. It was a lot of money. 1% of the stock. That's hysterical. I mean, that's
yeah, and that's the day the stock broke down, went from being a leader to a broken leader.
Right.
Yeah, they're probably worried he's just going to take it and sell it real quick.
Yeah. So it's always need price and to match the fundamental story. So for now, I think stay away from this one. The next one is PLNT. This is one that was acting good in the leisure services, but some red flags have came to light. There's a guy named Edwin Dorsey. He runs like a Bear Cave newsletter, and he does a lot of like good deep dives into companies and red flags. And he just recently published a report about Planet Fitness, and there was a lot of red flags that he found in the business and the company. And what he uncovered was hundreds of consumer complaints that was about fraudulent transactions, excessive fees, and uncancelable memberships. So I think what Planet Fitness bases their memberships around is it's probably one of the cheapest gym memberships around. It's like $10 a month. And what was happening is, I think they don't pride themselves, but they expect a lot of people to get the gym membership to forget about it and just to continue paying without even knowing. But people were trying to cancel their membership and they were unable to. So this is like a lot of lot of concerns with this business, and I think you'd want to stay away from it. Although on a technical standpoint, it's not looking horrible, but it was a very interesting report and a lot of red flags that he highlighted and dug deep into. Next one is Goldman Sachs. So financials were looking all right until Goldman had horrible earnings. Their profits plunged 69%, and their investment banking revenues were declining, and this is not a good sign for a growing economy. This was their worst earnings miss in a decade, and they missed the Wall Street expectation by a very large margin. And actually, what recently just came out is now the Fed is looking at Goldman's internal safeguards as it ramped consumer lending. This just came out like a couple minutes ago, and it's taken another hit. But when a stock is, selling off on this high volume, it's never a good sign.
Good
The
timing
next
on
one
that,
is,
Connor.
yeah,
Look at that! Look at that
literally
drop
just
just
came
in the
out.
last. Yeah.
Yeah, and it's
Ouch.
not liking that news. And then the next one is CALM. This is cal-maine foods, so they produce shell eggs and they distribute it in the Southwest, Midwest, and Atlantic region. So kind of something that we see like on a upside trade is when the stock gaps up, consolidates, and you look for a move higher. This is kind of the opposite scenario. It gapped down on above average volume, and now it's coming up to test these moving averages, and it's forming a bear flag. I think the case with this one is egg prices have just been on a crazy run, and this company is this has benefited them greatly. But I think it's already getting priced in to an extent now, and when you look at their 2024 earnings estimates, it's a huge decline from the previous years. So as the market's forward looking, maybe all of this earnings growth has been priced in, and there's not a whole lot of upside left in this one. And then the last one is YOU. This is Clear Secure. When you travel, when you go through, TSA pre-check and security, it's the software that uses biometrics to automate the verification process. This week, the stock was down 10% on 5 times average volume, and it was lacking a lot of institutional sponsorship. So it's rebounding today, but I think whenever a stock's down double digits on above average volume, that's a red flag. And that's all I've got today. Those are just 5 stocks that look a little bit weak, and yeah.
Was there any news on the 18th that caused that big high volume sell off? I know the market had a big reversal on
Yeah,
Wednesday, the 18th.
I couldn't find any news, so that's what I thought was interesting. I'm not sure if it was just based on the market or what, but I couldn't find any relevant things that explain why.
And one of the things we do as soon as we look at a stock is we multiply the average daily volume by the price. So you can see this is 1.1 million shares. It's a $27.50 stock, which puts it just above the minimum threshold that we'll look at, which is 25 million in daily dollar volume. The thinner you get on the stock, the less institutional support that it has, the wider the average true range will be, and you're really subjected to big moves like this on any sort of negative news or negative market action.
Well, yeah, they could
So we
be
got 5 good.
they could be manipulated, and the bid ask price, the lower the volume and the smaller the stock, the more prone they can be to manipulation too, as well.
So we got 5 good ones from Ted, 5 bad ones from Connor. Michael, you're the tiebreaker. What are you gonna talk about?
So yeah, to for the tiebreaker, I've got some good ones. Like to look at stay optimistic and try to concentrate on the good names. So what I'm looking at the moment, and I have positions in two of these, and I'm looking at getting back into two of them. To start off is a CCJ, Cameco. It's a uranium company. And basically, the story there is they produce about 7% of the world's uranium. They're the largest producer. And the bull thesis is an increasing global reliance on nuclear energy with growing geopolitical uncertainty and decarbonization targets. That's very supportive for uranium. So I like the sector going forward. And yeah, I bought it off the 200-day moving average. Low risk. It was holding up there pretty tight. So I thought I've been following it for a while and decided that that would be my entry. Another one I'm looking at, don't have a position in this, but it's acting pretty well, is SLB, Schlumberger, and that's an oil services company. They reported earnings today, and the earnings were positive, and they've increased their dividend. It's been riding that 8 EMA higher, and it's holding that breakout level. So we'll see if it can continue riding the trend higher. But now that earnings are out of the way, you've substantially reduced risk. So um, could could work, could fail. We'll see how it plays out. But the overall services industry, as you can see there, it's the number one group at the moment, showing extreme relative strength. So as long as the sector continues to perform, Schlumberger being the best in breed in that sector should do well. Then the third is pick. I have a position in pick, and that's the materials and basic metals miners, X, gold, and silver. Um, so basically, I chose pick because it's got all of the best names in that ETF. You've got BHP, Billiton, Rio, Valley, just all of the strongest names. So I thought instead of just picking a name, I like the sector a lot going forward. Copper has been the best performing metal for a few months now, and it's at 52-week highs, and yeah, just going forward, it's really a secular trend there with the decarbonization as well, electrification, all of that's going to require materials that we just don't have enough of at the moment. So I like it a lot going forward. This is hopefully a multi-year, long-term play, and I can sit and ride it. Bought it well. I bought it off the around the 200-day moving average, so I've got a nice gain, and don't plan on selling it. Hopefully, I don't need to anytime soon. And then the last two are the home builders, LEN, Lennar, and DHI. And I mentioned the two of them specifically because if I have a thesis on a sector, I like the strongest names. And I was holding XHB for a little while. That's the home builder ETF. Um, I sold it last week because it wouldn't really make sense heading into recession. There's a lot of risk in the housing market, and it would be very strange for DHI or Lennar to, even though they've been performing extremely well and they're some of the strongest names in the market, it wouldn't really make sense for them to be hitting all-time highs heading into a potential recession. So I just felt like there is a bull thesis there long term in terms of supply shortages and housing demand and family formations, but just the fact that they're near all-time highs, it seems like a lot of that's priced in. So I sold them and was hoping for a pullback. It looks like we are getting that pullback. I would love it if they pulled back to the 50-day, even the 200-day, and would like to see them start building a base again, and would definitely like to get back into them because I see housing home builders being a great sector going forward. So those are yeah, that's kind of what I'm looking at.
All right. Well, thank
All
you,
right.
Michael. I'm a little bit skeptical on the housing because I think interest rates are going to put a damper on things. I think it's cooling demand off, but you do have a shortage of supply. So we're going to have to see who wins, the supply or the demand. All right, Don, what do you got?
This is a year-to-date comparison chart of the 5 major indexes that we show in the nightly videos. And the thing that stands out to me is something completely contrary to what I thought we were going to see this year. I was expecting outperformance from the Dow because it's considered a more defensive sector. We've got the recession coming at us, according to all the genius economists. And we own this and got stopped out on it this week. And you can see from the year-to-date returns, the Dow is actually negative, well, basically flat. S&P up 2.3%, NASDAQ 100, which has been the whipping boy of the indexes for a while, up 4.6%, mid caps up 4.4, and small caps up 5.2. But what really got really caught me by surprise when you're making progress or well, first of all, let's go back to the thought that the Dow is defensive, and my expectation was it was going to outperform. We also owned a dividend ETF. This one is up for the year, but barely. So you would think if the market is going to be defensive, that low volatility stocks would be acting very well. This is SPLV, which is a low volatility ETF. It's down 5% down 2% on the year. Let's switch to high beta. You know that the Nasdaq has been disappointing. How about SPHB, high beta? Look what this has done year to date, up 9.5%. So this seems to be a little bit of a changing of the guard from the defensive sectors that had been acting better. And you really saw it this week with staples year to date down 3.2%, utilities down 3% on the year, real estate still up on the year, but having a bit of a rough week, and healthcare down 2% on the year. So staples, utilities, and healthcare, 3 of what people would normally think to go to in a tough market that they're going to hold up better. These are being sold, and the theory that we batted around internally is that this money could be going back into the S&P, more growthy sectors. Let's look at XLK. Tech is up 4%. XLC, communications, up 9.8%. And XLY, consumer discretionary, up 6%. So it's flowing, money is flowing from the defensive sectors into the more high beta sectors. And, this is the type of analysis that we do in here. We had a theory. The theory was that the Dow and dividends would outperform as we tried to recover. That's not what happened. We got stopped on the Dow. We've put that money into the S&P. We've put it into biotech. We've put it into the NASDAQ 100. Let's take a look at the biotech sector, XBI. That's up 3.4% year to date. So this again gets back to it's okay to be wrong. It's not okay to stay wrong. You can see the Dow Jones Industrial Average broke a key moving average. It broke below the 21 and the 50 this week. And I know I'm not the only one that was caught by surprise off of this. A lot of people that were defensively positioned in those quote unquote safe sectors, they're not always safe. Take a look at Procter and Gamble this week. That's a break from 155 to 140 in less than 2 weeks on big volume selling after they reported earnings. Procter and Gamble, you think that it would be a low PE stock. They've got a PE of 25 and their 2023 growth rate is 0. Next year it's 8%. Even best case scenario, that's a 3 PEG ratio, price earnings to growth. That's not what you typically think of when you take a look at defensive sectors. You can see what the stochastic's done, and you can see what relative strength is done. So analyzing the sectors and the leaders of these sectors and assigning sectors to the guys in-house is really helping us a lot to identify these types of trends. And today, what we're watching is we've had a harsh pullback. We've talked about it in the videos. This nonstop selling that happened on Wednesday, we're trying to recover some of it today. Yesterday, we had a close below the 21-day exponential moving average on the S&P, but we're reclaiming it and the 50-day today. As of 11:55 a.m. Eastern time, the Nasdaq 100 is up 1.4% and the S&P is up 0.8%. We've added back a little bit of the exposure that we took off earlier this week, and we'll ride the trend wherever it goes. I know the market's been tough, but at some point, it's been proven throughout history, we will get a very nice, strong uptrend with leadership stocks acting well, and we'll participate in it. So that's our take on the market right now. Things, I was very optimistic. As of 10:30 Eastern time on Wednesday, we survived this nice gentle pullback, a nice move up, and then we were up early, and then this again, this selling, it is what it is, only price pays. But we bottomed. I mentioned on the videos the key area to hold was this 3870-ish area. That's where we pulled back intraday yesterday. We held it overnight, and we're bouncing off of that today back above the key 3900 area. Which was kind of the upper end of the range. So as long as we stay above 3,900 in this week's lows, I think we're in good shape to increase exposure on the market.
All right, thanks, Don. What dog was that, Don?
That is Michael's dog.
Oh, that's Michael's.
Yeah. Ella.
Yeah.
Sprinkler people must be there.
Yeah. Hey. So I wanted to clarify. I wanted to add on to what Don said. So a lot of people feel like, and we did too, that tech was really going to struggle and continue to struggle, and value and dividend stocks would be the place to be, along with possibly some bonds. Well, bonds seem to be the place to be, but value and dividend stocks and the conventional, the big stocks, they're actually not doing well. Value and dividend stocks are getting hit and are down, and actually the growth names are what's happening the past week or two. You wouldn't think that. That's counter to your emotion and your feelings, and that's why it's so important to actually look at the data and see what actually is happening while it's happening and make adjustments accordingly, rather than try to prognosticate what you think is going to happen. So, it's okay to be wrong. You just can't stay wrong, and you'll get it wrong. Investing will come. You'll have mistakes. You just want to have nicks and cuts. You just don't want to have, sever the jugular. So you get a 30% drawdown, and then it takes years to recover. So, all right, folks. Well, listen, if you like what you heard, please tell a friend, tell a neighbor. Just send him to Revere, to ask him to go to revereasset.com. And up in the top right of our website, there's a subscribe button, and they can put in their name and their email. We won't reach out to them. We won't bug them. It's up to them to reach out to us and ask them if they want a confidential portfolio review, have a question of a stock. And actually, there's a contact us button next to the subscribe button where they can submit questions. You can also email us, any of us, at dan@revereasset.com, don@revereasset.com, Ted, Michael, or Connor at revereasset.com. And you can always call us old school at 855-REAL-WEALTH. Folks, have a safe and happy weekend, and we'll talk to you next week on Your Money.
Because it's not how much you make in the markets, it's how much you can keep.